Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. This video is the 9th episode in the multi-part series in which we're looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. This video is part 2 of how Mr. Buffett looks at the management of a company, particularly how management executives must conduct themselves. This means how are the incentives for the company's leadership structured, what actions management is taking or not taking, and are these aligned with the shareholders' interests? These insights are important for all value investors to understand and assess the management of companies that they are or will be investing in. To view earlier videos in this series, check out the description below or head to the channel's page. Before we start, please smash that like button and make sure to subscribe to receive next videos in the series on key lessons from Berkshire shareholder letters. Now let's dive into 2 key lessons on management conduct from Mr. Buffett. Number 1. Board of Director incentive must align with shareholder incentive. Mr. Buffett has a complicated relationship with boards of companies. On the one hand, he has a long history of serving on them. According to his 2019 shareholder letter, he has served as a director on the board of a total of 21 publicly owned companies over 62 years. On the other hand, he's deeply suspicious of what he sees as the modern-day trend of corporate boards incentivizing directors to be passive accomplices to whatever a CEO wants to do. Don't get Mr. Buffett wrong, boards aren't all bad for him. He identifies several recent promising changes in the culture around boards of directors, including the profusion of women on boards and the mandating of CEO-free sessions where executives can speak frankly. But there is one big problem. The majority of CEOs aren't actively looking for directors to challenge their decision-making. Despite the fact that boards normally seek directors with independence, the actual behavior of executives and other directors seem to disregard this idea. A significant part of the problem is director compensation, which Buffett argues has soared to a level that inevitably makes pay a subconscious factor affecting the behavior of many non-wealthy members. Board directors are regularly paid more than $250,000 a year for the work of attending 6 or so annual meetings. They are seldom fired and can generally serve well into their 70s. All of this adds up to a strong set of incentives to do whatever it takes to stay on the board. In most cases, that means never challenging their CEO. Companies are eager to find these kinds of directors, but counterintuitively reject those who have a large amount of their net worth tied up in the companies they serve. These directors, despite possessing fortunes very substantially linked to the welfare of the corporation, are ignored and deemed lacking independence. Instead of being valued for the amount of skin they have in the game, they're pushed aside. According to Mr. Buffett, the result is a set of incentives that isn't good for companies. When directors have skin in the game, they're more likely to look out for the company's best interests. When you have directors who are in it for the money, you're likely to get an absentee board and worse outcomes. He points out, not long ago, I looked at the proxy material of a large American company and found that 8 directors had never purchased a share of the company's stock using their own money. They of course had received grants of stock as a supplement to their generous cash compensation. This particular company had long been a laggard, but the directors were doing wonderfully. Setting the question of incentives aside entirely, Mr. Buffett offers another key observation about directors. while he's confident that he admires many of the people he has served alongside on corporate boards, he says there is one thing he feels less confident about, that he wants those people responsible for his money. According to him, almost all of the directors I have met over the years have been decent, likable and intelligent. Nevertheless, many of these good souls are people whom I would never have chosen to handle money or business matters. It's simply not their game. Number 2, investment banker incentives are usually not shareholder incentives. While Mr. Buffett and Berkshire Hathaway conduct plenty of business with investment banks and have invested in a few, he has issued some pointed criticisms at the industry over the years. His main problem with investment bankers is that their financial incentive is always to encourage action, sales, acquisitions and mergers, whether or not doing so is in the interest of the company initiating the action. He shares that investment bankers, being paid as they are for action, constantly urge acquirers to pay 20 to 50% premiums over market price for publicly held businesses. The bankers tell the buyer that the premium is justified for control value and for the wonderful things that are going to happen once the acquirer's CEO takes charge. What acquisition-hungry manager will challenge that assertion? A few years later, bankers bearing straight faces again appear and just as earnestly urge spinning off the earlier acquisition in order to unlock shareholder value. Sometimes this thirst for action even leads bankers to use fuzzy accounting to value the companies they're selling. Mr. Buffett's frustration with investment banker math reached its boiling point in his 1986 letter to shareholders, in which he dissected the value of Berkshire's latest acquisition, the Scott Fetzer Company. Mr. Buffett does not believe that standard GAAP accounting figures always give an accurate idea of what a company is worth, so he walks through a valuation of Scott Fetzer Company to explain why Berkshire purchased that company. He wanted to show that typically, when one looks at a company through the lens of the earnings it will produce for its owners, the result is sobering relative to the company's GAAP numbers, and that investment bankers and others use faulty numbers to push the companies they're selling. According to Mr. Buffett, all of this points up the absurdity of the cash flow numbers that are often set forth in Wall Street reports. These numbers routinely include earnings plus depreciation, amortization, etc., but do not subtract capital expenditure and the cost of maintaining its competitive position. Most sales brochures of investment bankers also feature deceptive presentations of this kind, implying that being offered is the commercial counterpart of the pyramids, forever state-of-the-art, never needing to be replaced, improved or refurbished. For Mr. Buffett, investment bankers are too often simply using whatever math most preferable for their preferred outcome, whether or not it's deceptive to the buyers and sellers involved in the transaction. The sad part is that you will see certain companies' management agreeing to these recommendations. So, as value investors, we must closely scrutinize the actions of management, or even better, look for credible management, which Mr. Buffett has always stated as one of his key criteria in buying any company. For now, that's it from us. Hope you enjoyed and learned from these lessons. Please smash that like button, and for other videos in the series, check out the description below or the playlist above, or head to the channel page. And subscribe to make sure that you receive the follow-up videos on key lessons from Warren Buffett's Berkshire letters. Thanks for watching.